When it comes to investing, every single decision really boils down to one of two competing philosophies. One approach is kind of like being a detective, searching for some hidden underlying value. The other, well, that's more like a fortune teller, trying to read patterns in the market's chaos. Today, we're going to put them head to head. I mean, it's the million-dollar question, right? You're faced with this absolute ocean of options. Thousands of stocks. How do you even begin to choose? Do you put on your investigator hat and dig into the company's fundamentals? Or do you try to surf the market's mood swings, predicting its next big move? These two ways of thinking are really at the heart of everything.
All right, so first up, let's meet the detectives. These are the folks who, metaphorically speaking, put on their trench coats, pull out their magnifying glass, and launch a full-blown investigation into a company. They're not interested in all the market noise. They just want the cold, hard facts.
And this right here is their secret weapon. It's called fundamental analysis. It's all about figuring out the true value of a stock. It totally ignores the day-to-day madness of the market and instead zeroes in on the health and performance of the actual business. Think of it like this. You're valuing a house based on its solid foundation and its location, not the frantic bidding war that's happening out on the lawn.
So what kind of clues is our detective actually looking for? Well, pretty much everything. They're digging into the quantitative stuff, poring over financial statements, checking cash flow, looking at all the key ratios. But they also look at the qualitative side, which is just as important. We're talking about things like how good is the management team? How strong is the brand? Do they have any patents that could be a game changer? See, their whole philosophy is built on one simple idea. In the short term, the market can be wrong. So their goal is to find a fantastic company the market has kind of overlooked, buy it for cheaper than it's worth, and then just wait for everyone else to figure it out.
And this quote just sums up that patient mindset perfectly. It's a long game. The whole belief is that the investment will pay off over time, but only once the market finally catches on and realizes the fundamental value of a company.
Okay, now let's switch gears completely and meet our second character, the Chartist. Now, the Chartists, they couldn't care less about a company's balance sheet or who its CEO is. For them, the only truth that matters is found in those squiggly lines on a price chart.
And this is the world of technical analysis. It completely ignores what's going on inside a company and instead focuses entirely on the market's behavior, analyzing things like past prices and how much is being traded. So it's not about a company's health at all. It's about crowd psychology, momentum, and patterns.
You see, the Chartist lives by a totally different set of rules. First, they believe the market price already reflects all the information out there. All that fundamental stuff is already priced in. Second, they believe prices don't move randomly, they move in trends. And third, and this is the big one, they believe history repeats itself because human psychology, well, it's pretty predictable. So here's the main takeaway. They are not looking for value. They're just trying to figure out where the price is headed next. So what are they actually looking at in these charts? Well, they're hunting for patterns that might give them a hint about what's coming. For example, they'll look for a clear uptrend to confirm that things are moving in the right direction. Or maybe they spot a triangle pattern. That's where the price moves into a tighter and tighter range, signaling a potential breakout. And then there's the famous head and shoulders pattern, which is a classic warning sign that a rising stock might be about to turn around and fall. Okay, so we have two radically different ways of looking at the market. One is this deep investigative dive into a business, and the other is a study of market psychology and patterns. Let's really put them side by side.
And you can see the contrast so clearly right here. Where the detective is reading financial reports, the Chartist is staring at price charts. This single difference leads to completely opposite timeframes. The detective is in it for the long haul, thinking in years, while the Chartist could be thinking in weeks, days, or even minutes. Ultimately, it really just boils down to investing versus trading.
So, which one is right? Who wins? The detective or the Chartist? Well, what if I told you that the smartest people in the room don't actually pick a side? They use both.
This is probably the most important insight of all. These two methods, they aren't rivals fighting each other. They're actually complementary. In fact, their differences are what make them so incredibly powerful when you use them together. So how does that actually work?
Okay, here's the professional's playbook. And it's actually pretty simple. It's 2 steps. Step 1, you use fundamental analysis, all that detective work, to find a great, healthy company that's selling for a good price. That answers the question of what to buy. But, and this is key, you don't buy it just yet. Step 2, you switch hats and use technical analysis, the Chartist tools, to find the perfect moment to get in. This answers the all-important question of when to buy.
And this is exactly why that combination is so powerful. Because a great company, the what, might not be a great investment if your timing, the when, is just plain wrong. I mean, buying an amazing company right at the peak of a market bubble can be a total disaster. By combining the two methods, you can find that good company and then patiently wait for the right moment to make your move.
So this leaves us with one final question for you. When you think about making decisions, are you more of a detective, always digging for those fundamental truths? Or are you more of a chartist, looking for patterns and momentum? You know, maybe the most effective strategy, not just in investing but in, well, anything, is learning how to be a little bit of both.